Chapter 13, Overview of Internal Control. Nature and purpose of internal control. Internal control is the process designed and effected by those charged with governance, management, and other personnel to provide reasonable assurance about the achievement of the entity objectives with regard to reliability of financial reporting, effectiveness, and efficiency of operation and compliance with applicable laws and regulations. It follows that internal control is designed and implemented to address identified business risks that threaten the achievement of any of these objectives. Those objectives fall into three categories. The one is reliability of entities' financial reporting, effectiveness and efficiency of operations, compliance with applicable laws and regulations. Whether an entity achieves its objectives relating to financial reporting and compliance is determined by activities within the entity's control. However, achieving its objectives relating to operation will depend not only on management decision but also on competitor action and other factors outside entity. Internal control system defined. Internal control system means all the policies and procedures, internal controls adopted by the management of an entity to assist in achieving management objective of ensuring as far as practicable the orderly and efficient conduct of its business, including adherence to management policies, the safeguarding of assets, the prevention and detection of fraud and error, the accuracy and completeness of accounting records, and the timely preparation of reliable financial informations. Elements of internal control. Internal control structures vary significantly from one company to the next. Factors such as the size of the business, nature of operation, the geographically dispersion of its activities and objectives of the organization affect the specific control features of an organization. However, certain elements or features must be present to have a satisfactory system of control in almost any large-scale organizations. The internal control system extends beyond these matters which relate directly to the function of the accounting system and consists of the following components. A. The control environment. B. The entity's risk assessment process. The information system including the related business processes relevant to financial reporting and communications. D. Control activities. E. Monitoring of controls. A control environment. The control environment which means the overall attitude, awareness, and action of directors and management regarding the internal control system and its importance in the entity. The control environment has an effect on the effectiveness of the specific control procedure. A strong control environment, for example, one with tight budgetary controls and an effective internal audit functions, can significantly complement specific control procedures. However, a strong environment does not by itself ensure the effectiveness of the internal control system. Factors related in the control environment include the function of the board of directors and its committees, management philosophy and operating style, the entity's organizational structure and method of assigning authority and responsibility, management's control system including the internal audit function, personnel policies and procedures, and segregations of duties. The environment in which internal control operates has an impact on the effectiveness of the specific control procedures. Several factors compress the control environment, including communications and enforcement of integrity and ethical values. Integrity and ethical values are essential elements of the internal control environment. They affect the design, administration, and monitoring of other components of internal control. an entity ethical and behavioral standards and the manner in which it communicates and reinforces them determine the entity's integrity and ethical behavior. Integrity and ethical values include management action to remove or reduce incentives and temptations that might prompt personnel to engage in dishonest, illegal, or unethical acts. They also include the communication of entities, values, and behavior standards to personnel through policy statement, a code of conduct, and management example of appropriate behavior. 2. Commitment of competence. Competence is the knowledge and skills necessary to accomplish tasks that define an employee's job. Commitment to competence means that management consider the competence level for particular jobs in determining the skills and knowledge required of each employee and that it hires employees competent to perform the task. 3. Participation by those charged with governance. An entity control consciousness is influenced significantly by those charged with governance. Attributes of those charged with governance include independence from management, their experience and stature, the extent of their involvement and scrutiny of activities, the appropriateness of their actions, the information they receive, the degree to which difficult questions are raised and pursued with management, and their interaction with internal and external auditors. The importance of responsibilities of those charged with governance is recognized in codes of practice and other regulation or guidance produced for the benefits of those charged with governance. Other responsibilities of those charged with governance include oversight of the design and effective operation of whistleblower procedures and the process for reviewing the effectiveness of the entity's internal control. 4. Management philosophy and operating style. Those thus refers to management attitude towards business risk, financial reporting, meeting budget, profit, and other established goals which all have impact on the reliability of the financial statement. 5. Organizational structure. The responsibilities and authorities of the various personnel within the organization should be established in such a manner as to assist the entity in meeting its goals and objectives and ensure that transactions are processed, recorded, summarized, and reported in accurate and timely manner. Organizational structures provide the overall framework for planning, directing, and controlling operation. 6. Assignment of authority and responsibility. Personnel within organization need to have a clear understanding of their responsibilities and the rules and regulations that govern their action. Management may develop job descriptions, computer system documentation. It may also establish policies regarding acceptable business practice, conflict of interest, and code of conduct. 7. Human resource policies and procedures. Perhaps the most important elements of an internal accounting control system is the people who perform and execute established policies and procedures. Personnel policies should be adopted by the client to reasonably ensure that only capable and honest persons are hired and retained. Policies with respect to employee selection, training, and supervision should be adopted and implemented by the client. The selection of competent and honest personnel does not automatically assure that errors or irregularities will not occur. However, adequate personnel policies coupled with the design concept suggested earlier in this section enhance the likelihood that the client's policies and procedures will be followed. B. Entity risk assessment process. Risk assessment is the identification, analysis, and management of risk pertaining to the preparation of financial statement. For example, risk assessment may focus on how the entity considers the possibility of transaction not being recorded or identifies and assesses significant estimates recorded in the financial statements. An entity risk assessment process it is process for identifying and responding to business risk and the result therefore. For financial reporting purposes, the entity risk assessment process include how management identifies risks relevant to the preparation of financial statements that are presented fairly in all material respect in accordance with the entity's applicable financial reporting framework, estimates their significance, assesses the likelihood of their occurrence, and decides upon action to manage them. For example, the entity risk assessment process may address how the entity considered the possibility of unrecorded transaction or identifies and analyze significant estimate recorded in the financial statements. Risks relevant to reliable financial reporting also relate to specific events or transactions. Risks relevant to financial reporting include external and internal events and circumstances that may occur and adversely affect an entity's ability to initiate, record, process, and report financial data consistent with the assertion of management in the financial statement. Once risks are identified, management consider their significance, the likelihood of their occurrence, and how they should be managed. Management may initiate plans, program, or action to address specific risks, or it may decide to accept a risk because of cost or other considerations. Risks can arise or change due to circumstances such as the following. The first is changes in operating environment. Changes in the regulatory or operating environment can result in changing in competitive pressures and significantly different risks. New personnel. New personnel may have a different focus on our understanding of internal control. New or revamped information system. Significant and rapid changes in information system can change the risks relating to internal control. Rapid growth. Significant and rapid expansion of operation can strain controls and increase the risk of a breakdown in control. New technology. Incorporating new technologies into production processes of information system may change the risk associated with internal control. New business models, products, or activities. Entering into business areas or transactions with which an entity has little experience may introduce new risks associated with internal control. Corporate restructuring. Restructuring may be accompanied by staff reduction and changes in supervision and segregation of duties that may change the risks associated with internal control. Expand foreign operation. The expansion of acquisition of foreign operation carries new, often unique risks that may affect internal control. For example, additional or change risk for foreign currency transactions. New accounting pronouncements. Adoption of new accounting principle or changing accounting principle may affect risk in preparing financial statement. The basic concept of the entity risk assessment process are relevant to every entity regardless of size, but the risk assessment process is likely to be less formal and less structured in small entities than in larger ones. All entities should have established financial reporting objectives, but they may be recognized implicitly rather than explicitly in small entities. Management may be aware of risks related to this objective without the use of a formal process, but through direct personal involvement with employees and outside parties. Considerations specific to smaller entities. Many small entities are carried out entirely by the engagement partner, who may be a sole practitioner. In such situation, it is the engagement partner who, having a personally conducted the planning of the audit, would be responsible for considering the susceptibility of the entity's financial statement to materials misstatement due to fraud and error. C. Information system including the business process relevant to financial reporting and communications. An information system consists of infrastructure, physical hardware components, software people, procedures, and data. Infrastructure and software will be absent or having less significance in systems that are exclusively or primarily manual. Many information systems make extensive use of IT. The information system including related process relevant to financial reporting. The information system relevant to financial reporting objectives, which include the accounting system, consists of procedures and records designed and established to initiate record, process, and report entity transaction, as well as event and condition, and to maintain accountability for the related assets, liabilities, and equity. Resolve incorrect processing of transaction. For example, automated suspense files and procedures followed to clear suspense items out on a timely basis. Process and account for system overrides or bypasses to controls. Transfers information from transaction processing system to the general ledger. Capture information relevant to financial reporting for event and condition other than transaction such as the depreciation of amortization of asset and changes in recoverability accounts receivables. Ensure information required to be disclosed by applicable financial reporting framework is accumulated, recorded, processed, summarized, and appropriate reported in the financial statements. Journal entries. An entity's information system typically include the use of standard journal entries that are required on recurring basis to record transactions. Examples might be journal entries to record sales, purchases, and cash disbursement in the general ledger or to record accounting estimates that are periodically made by management, such as changes in estimate of uncollectible account receivable. An entity's financial reporting process also include the use of non-standard journal entries to record non-recurring, unusual transaction or adjustment. Example of such entries include consolidating adjustment and entries for a business. Dumo. A business combination or disposal of non-recurring estimates such as the impairment of an asset. In manual general ledger system, non-standard journal entries may be identified through inspection of ledgers, journals, and supporting documentations. Related business processes. An entity business processes are the activities designed to develop, purchase, produce, sell, and distribute an entity's products and services. Ensure compliance with law and regulations. Record information including accounting and financial reporting information. Business processes result in the transaction that are recorded, processed, and reported by the information system, obtaining an understanding of the entity business processes, which include how transactions are originated, assist the auditor obtain an understanding of the entity information system relevant to financial reporting system relevant to financial reporting in a manner that is appropriate to the entity's circumstances. Accordingly, an information system encompasses methods and records. Identify and record all valid transactions. Describe on a timely basis the transaction is sufficient detail to permit proper classification of transaction for financial reporting. Measure the value of transaction in manner that permits recording their proper monetary value in the financial statements. Determine the time period in which transaction occurred to permit recording of transaction in the proper accounting period. Present properly the transaction and related disclosures in the financial statements. Communication involves providing an understanding of individual roles and responsibilities pertaining to internal control over financial reporting. It includes the extent to which personnel understand how their activities in the financial reporting information system relate to the work of others and the means of reporting exception to an appropriate higher level within the entity. Other communication channels help ensure that exceptions are reported and acted on. Communication takes such form as policy manuals, accounting and financial reporting manuals, and memoranda. Communication also can be made electronically, orally, and through the action of management. Application to small entities. Information systems are related business processes. Relevant to financial reporting in small entities are likely to be less formal than in larger entities, but their role is just as significant. Small entities with active management involvement may not need extensive descriptions of accounting procedures, sophisticated accounting records, or written policies. Communication may be less formal and easier to achieve in a small entity than in a larger entity due to the small entity's size, fewer level, as well as management greater visibility and availability.